In this video, we look at how financial results come from a result of implementing strategy. As we looked before, financial reporting and financial statement analysis is different. Financial reporting is providing financial information. It includes financial states and others. Financial statement analysis is using that financial information to assess prior performance and likely future performance to make decisions. The decisions, and they all come down to having a recommendation, but they fall into one of these three categories: debt issuance and lending money, equity investment, controlling, not controlling, or allocation of capital. When we're done with the analysis, we make a recommendation. Now, why do we need to take time to understand about the firm? Isn't all about the numbers, that if we look at the numbers, the financial statements, we should be able to do certain quantitative analysis and conclude what about the past and the future? Well, no. The financials reflect the outcome of management actions, historical financials, from what is produced, how it's sold, what support is needed, what working capital and equity decisions that are made. So the financial results are an outcome from management engaging in certain practices and strategies. Now, you know how we spent time identifying how the company generates sales. Okay? So what's next as we keep that going? Well, what strategies or actions did the company take to generate those results? They had to do something. They needed a strategy, a plan, an approach. It didn't just happen. It was a result of something. Since we're going to make a recommendation about the future, we need to examine the strategies the company is going to implement in the future. The majority of these strategies can be found in the investor presentation. What strategies should you look at? There's going to be a number of strategies that they will talk about. You want to focus in very clearly on those that drive revenue. So when you're looking through the investor presentation, what is the strategy they're going to engage in to increase volume? You should have already created the volume and rate indicators. But now, what's the strategy to increase that? Is it a strategy that will change the mix of sales to add more value-added products? Is it measurable? Can you quantify the impact of implementing this strategy? You might not have everything you need, but you may need to make certain assumptions in order to estimate it. But this is where you start tying things together. Lastly, is it material? Is it big enough to move the needle? I mean, if a company does $10 billion in sales and something's going to only increase it by $100 million, that ain't going to do it. Okay? So you're going to look at the strategies, focus on those that will drive revenue. Acquisitions could be a strategy. That's okay. A company needs revenue growth to be successful over time. That's the simple bottom line. They need revenue to be successful. There's other strategies. Some will talk about reducing expenses, and this can be a good thing. But just cutting cost is not always a sustainable model. It may create profit in the short term. Now, if it's sustainable strategy because you're using AI, robotics, or something that is going to be permanent, that's a strategy that might be important. But we're not going to look at that until we start forecasting expenses. Okay? Other strategies may be about managing their capital structure to produce certain returns by the way they set up the mix of debt and equity. We're going to take a look at some of them when we do the capital section. Customer service is always a platitude. Every company's got to have it in. They want to treat their customers right. They want to treat their employees right, their suppliers right. Those are all good things, but those are what I'll call basic expectations. We need the company to do that. Without them, they're not going to be able to generate that revenue. So we want to focus on those things that have an impact on revenue. Now, when you do this, every strategy has risks. They're not guaranteed. So we want to look at these and say, what are some of the risks? Identify them. External risk, the economy. Okay, if the economy slows or goes faster, that'll have an impact. Some are internal risks, such as the ability to keep projects within budget. The customer doesn't embrace the new strategy or the new product. So we want to identify the risk. Here's an example from STLD, Steel Dynamics, and this is a summary. And I went through it. Expand existing capacity by building new lines and mills. Expand product lines by acquiring companies. Now, I found this in the investor presentation, and it tells me what they're going to be doing. So I know here what's going to happen. Okay? So I got that information right off of the investor presentation, and I put it on this sheet. What are the risks to this strategy? Well, there's a long time framework to construct new facilities and acquire companies. In the meantime, market demand may change as the economy slows, resulting in underutilization. Tariffs may come into play. The ability to keep things under budget. This one is a good one. There's always stuff for sale. If you want to buy something, the question is can it be bought at a fair price? So as you're looking at your company, and that may be a strategy, will they be able to find them at a fair price they can make money? This is an example. Looking at the next one, growth strategy 2, let's just go right to this, is what they want to do is product diversification. They want to switch to a higher value-added product. So they talk about that, angles and quality blooms and reinforcing bar. So what they're doing is expanding value-added, higher margins, by growing organically, meaning from within. They're going to focus on markets that are poised for growth, such as infrastructure. Maybe that's going to go somewhere. Maybe it's not. We're in a very unusual political situation. They plan to increase utilization and diversify product offering by over 500,000 tons over the next year. Okay, increase in sales of about 750 million per year. Okay, the risk is market demand. So if they do all these things and the market isn't there, that's a risk. So here's another example. This is from Baxter, I believe. Strategies for revenue growth. They're going to do two things. They're going to do portfolio innovation, which is executing on their pipeline opportunities and geographic expansion, and then enter adjacencies beyond the core to unlock new therapies and markets. So they're two separate and distinct ones. And this group went through, here's the impact. They got a number. They got it right out of the investor presentation. And there's the risk. The FDA may not approve. International business risk, you're doing business overseas. There's exchange rate risk. There is regulations. There's governmental policies. But this is what they want to do. Okay? New product sales in 2023, $1.7 billion. They got that. Okay? This one, enter adjacencies. They think there's $6 billion in new market opportunities. And they define what it is, the risk. Top talent, competition for top talent to attract newly qualified people. So that's there's a couple of examples of what we found. This is what in Project 2 you're going to have to be looking at. So when we think of strategy, we're going to have a whole section on planning, but keep in mind when you're looking for these who, what, when, where, and why. How, who, what, when, where, and why. What is the strategy? What are they doing? Who's going to do it? What are they going to do? When are they going to do it? Where, why, and how? So this is about connecting the dots, thinking and tying pieces together to tell a story. But it all builds on what are the drivers. So you look at it historically, and now you apply it. So I want you to start putting this in your head and thinking about this when you're preparing Project 1 and you're reading the 10K, you're reading the investor presentation. If you got any questions, please let me know.